Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The story of SLS Life Sciences Group, or SLS, is giving us, I think, one of the most volatile and complex narratives in the small-cap biotech space right now. We're focused today on the really rapid, high-volume price action we saw closing out December of 2025. After a crucial update on their phase 3 REGAL trial for the cancer vaccine Galimpa-Capumet-S, the stock just surged. We're talking about 30% in 3 days, moving from the low 240s to over 330 on really significant volume. It was a clear repricing event.
And that rapid repricing is really the heart of the issue, isn't it? The market is scrambling to figure out what exactly drove that movement.
Absolutely. And the central question we have to unpack is whether this appreciation is, fundamentally driven by the promising clinical signal, what we're calling the bullish delay in the death event count, which is stalled at 72 out of 80, or if it's primarily a market phenomenon. Something triggered by, let's say, extreme technical vulnerability, specifically that massive short interest. My position is clear. The clinical signal is paramount. This move is sophisticated money correcting a profound undervaluation based on powerful implicit data.
I see it very differently. While the clinical side is interesting, I believe the movement is overwhelmingly a function of market microstructure. It's a classic short squeeze dynamic. And for that reason, this rally is structurally unsound. It's not defined by the fundamentals of the drug, but by a history of corporate malfeasance and the frankly overwhelming risk of shareholder dilution. This is a battleground stock defined by mechanics, not medicine.
Okay, so let me outline the evidence for the primacy of the clinical signal. The bullish delay, in my view, is the strongest possible non-public signal you can get before a final data readout. And you have to understand it in the context of the trial population. The REGAL trial is focused on acute myeloid leukemia patients in second complete remission, or CR2. This is a notoriously fragile patient population, sometimes even called a death sentence population, where the median overall survival is historically just bleak, often only 6 to 8 months with the best available therapy.
And it's crucial to remember that context. The standard of care provides very little hope.
Precisely. So now, consider the timeline. Enrollment of all 126 patients was done by April 2024. Now, if GPS were clinically ineffective, meaning it performed no better than that historical baseline, the 80th required death event should have mathematically occurred by mid-2025. It is now late December 2025, and the count remains stalled at 72. This fact suggests a highly significant divergence in the survival curves, specifically a survival tail forming, which is favorable to the treatment arm. We know GPS targets the WT1 protein, which the National Cancer Institute itself called one of the highest priority immunotherapy targets, by stimulating a really robust response from both CD4+ and CD8+ T cells, so there's a strong theoretical basis for this. This surge is an information asymmetry correction.
195 just confirms this trend reversal is based on fundamentals.
Okay, that's a compelling argument for the drug's potential, I'll grant you that. But it assumes the market is behaving rationally based on a clinical inference. I hold that the stock is trading as a battleground equity defined by its microstructure and a frankly poisoned corporate legacy. This makes the price spike incredibly hazardous for the average holder, and the evidence for a technical squeeze is just overwhelming and, I think, much more immediate than the clinical optimism. We're looking at a setup known as a crowded short. Roughly 40.5 million shares sold short, which is nearly 29% of the tradable float. For context, anything over 20% is considered highly shorted. And crucially, the days to cover, or DTC, stands at 7.1. A DTC over 4 makes a stock highly vulnerable. At 7.1, short sellers are severely trapped. So the 30% surge we saw is a textbook reaction to positive news hitting this very specific, vulnerable setup. But even this is overshadowed by the company's financial history. We just cannot ignore its corporate archaeology. We're talking 3 severe reverse stock splits in a decade, culminating in a cumulative 1 to 30,000 reduction for long-term holders. That history establishes a deep-seated distrust.
A legacy of extreme shareholder dilution, certainly.
Exactly. And that legacy fuels the constant threat of massive, market-crushing dilution via at-the-market offerings. Management has a clear fiduciary duty to shore up their cash. If the price gets to strategic thresholds like $5 or even $7, this rally will inevitably introduce a, quote, flood of new paper supply, and that guaranteed dilution will simply erase recent gains. The mechanics are driving the price, but the corporate structure guarantees volatility and potential pain. Let's focus on those clinical inferences you champion and the corporate backdrop. While I acknowledge the CEO's statement that survival times appear longer than expected, we have to apply a rigorous skepticism here because of where those words are coming from. SLS is essentially a hermit crab living in the toxic shell of Galena Biopharma. That company brought with it the baggage of severe legal trouble, the 2017 opioid kickback scandal, and the notorious 2014 Dream Team stock promotion scheme. Institutional memory around this legacy is profound. This history means you have to heavily discount any unblinded inference from management, regardless of how plausible the delay seems. The market views this ticker through a lens of past deception.
I see why you think that, and I agree the archaeology of the predecessor company is grim. However, the data has to be separated from the operational history. The AML-CR2 population is notoriously fragile. BA-TET, the clinical standard, rarely outperforms those bleak historical baselines. We're not talking about a subtle shift here. We are talking about the difference between a high probability event completion in mid-2025 and a late 2025 stalling at 72 out of 80. That delay isn't just a subjective claim from management. It's a statistical reality that strongly implies a survival tail is being created by GPS. That objective implication can't just be dismissed by past corporate missteps unrelated to the current management or the biology of the drug. The clinical basis, WT1 being a top NCI target, that remains the key validation point. The data is compelling enough statistically to overcome the stigma.
But the structural instability acts as an active magnifier of that corporate risk. When investors are burned repeatedly, they interpret all volatility through that lens of distrust.
That's an interesting point, though I would frame it differently. I agree that the extreme microstructure is a defining feature, but I maintain it's not the cause of the recent appreciation. It's the amplifier for the legitimate clinical news. Just consider the role of dark pools. The high off-exchange short volume, we saw it spike to over 70% of total volume on December 17th. It creates a severe liquidity vacuum on the public or lit markets. When so much trading is handled off-exchange, there are just fewer shares available for short sellers to cover easily. This opacity, which a lot of retail investors call dark pool suppression, meant that when the positive news hit on December 29th, shorts were forced to cover rapidly on the public exchanges.
And the violent price movement followed because that buying pressure was confined to the lit markets.
Precisely. That violent bidding proved the underlying strength of the news. This is a dam-breaking dynamic. The microstructure didn't create the bullish sentiment. It merely amplified the correction that began when people realized patients on GPS are living significantly longer than expected. The technical setup just accelerated the realization of the clinical value.
I'm sorry, but I just don't buy that the microstructure is a neutral amplifier. Let me tell you why. While that liquidity vacuum certainly causes volatility, the high dark pool activity is often cited by the retail investor community as evidence of intentional price suppression by institutional funds. This us versus them narrative creates a diamond hands culture where these holders are psychologically entrenched in defending a temporary floor. This behavior does not equate to sustainable institutional confidence or long-term value. This opacity fundamentally separates the public price from true trading interest. And we have to address the obvious technical overheating. The stock has already overbought, with the RSI, the Relative Strength Index, reading between 75 and 81. An RSI over 70 is unsustainable in the short term. It indicates a significant pullback is highly probable, regardless of the clinical inference. The structural risk is immediate.
But focusing narrowly on the overbought status, which is a temporary function of the squeeze, it misses the extraordinary potential upside here. The potential reward, if GPS succeeds in prolonging survival, effectively turning a terminal diagnosis into a manageable chronic condition, that provides an extraordinary valuation ceiling. We see this reflected in the constant market hum of buyout speculation. Valuation targets thrown around
based on peak sales estimates range from $5 billion to $15 billion. The current market cap is only around $489 million. That differential is why sophisticated money is entering. And from a purely technical perspective, the stock is broken clear of multi-month resistance. It's now poised to challenge $3.50 and $4, and that can lead to a rapid run toward $5 because of what's known as a volume gap. The reward, I think, far outweighs the near-term risk.
I respect the clinical optimism and respect the theoretical valuation ceiling, but the financial risk is not theoretical. It is a certainty baked into the company's fiscal management. While a technical run to $4 or $5 might exist purely on squeeze strength, the certainty of dilution cannot be overstated. We know this company is a cash-burning entity. They had $44.3 million in cash in Q3 2025 and already raised $31 million in October. They're actively managing their cash runway. If the price sustains this appreciation, management will activate their at-the-market offering to raise more capital. This isn't optional. It's a mandatory fiduciary responsibility to secure funding for commercialization. That inevitable issuance of millions of new shares will fundamentally prevent any long-term sustained appreciation. Regardless of clinical success, dilution acts as an unavoidable permanent headwind.
But that assessment, the certainty of dilution, it's a bet against the ultimate success of the drug. If the unblinded data is definitively positive, which the delay strongly suggests, the subsequent massive valuation re-rating will instantly absorb any short-term dilution. The $489 million market cap does not reflect the value of a successful AML treatment. The price action we saw in late December reflects sophisticated money realizing this fundamental disconnect and acting on the implicit clinical success signal.
And the price action I see reflects short sellers panicking because they were caught with a 7.1 days to cover on a stock with a documented history of catastrophic dilution. It's a temporary dynamic built on excitement and vulnerability, not on genuine, sustained institutional security.
Ultimately, the clinical data remains the single most important factor. And the evidence from the delay in reaching 80 deaths, it strongly tilts the odds toward a positive outcome. It suggests the current price reflects a justified correction of prior unwarranted undervaluation.
And I reiterate that investors have to distinguish between the temporary excitement of a short squeeze fueled by that dangerous DTC metric and genuine sustained value. The weight of the Galena legacy, combined with the imminent threat of dilution, means this equity remains high risk and high volatility, suitable only for those prepared for the binary climax that the 80th event represents.
This narrative arc, a highly promising drug, GPS, fighting against a sort of corporate villain in the form of market mechanics, in a toxic history, it perfectly encapsulates the complexity of the small-cap biotech sector.
And the ultimate conclusion hinges entirely on which force proves stronger when that final, unblinded data is released. Until then, both the hope and the hazard remain extreme.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.